about it. And today we're going to talk about what to do to prepare for really an impending recession and how this could affect your ability to get money, especially get money at really good terms. So by the end of this training, we're really going to dive in to figure out what's going on, how to get around it, and how to set yourself up for success to be able to get money for like the next chapter of whatever may happen in the economy. So look, a lot of things are happening, right? Inflation's on the rise, recession's likely, hard economic times force lenders to make some changes. And again, I'm not trying to scare you, I'm just trying to talk about reality. We saw when COVID hit this massive contraction of what lenders were willing to do. I mean, lending almost ceased until lenders started to figure out what happened, and then it started to open up slowly but surely. So we've already been through this in recent years, and now we've got all these other things floating around with record high gas prices, inflation, recession potentially right around the corner. And as a result of that, a lot of lenders are already making adjustments now, and others will be in the process of making adjustments in the weeks, months to come. So what is underwriting? Well, when we talk about underwriting loans, we're talking about basically the process lenders use to determine the risk of non-payment and then determine if the loan's going to be approved, the rates and terms are going to be approved for, and how much money you're going to get, right? So higher risk situations means higher interest rates or denial. And we saw a lot of this in COVID, right? We saw that industries like restaurants were almost impossible to lend to at the same time, because what happened was that, they were shut down completely. So their revenues completely ceased. So when this happens, what ultimately goes down is that lenders start to redesignate certain industries as high risk for whatever the economic conditions are. So even if you're not high risk now, it's something you got to keep an eye out for, because you could be determined to be high risk in the actual months to come, or as underwriting guidelines start to change, as we start to see more contraction, as we start to see it harder to be able to get financing. Then when we talk about commercial loan underwriting, well, it's just a lot more in depth, because if you're trying to get a personal loan, a personal car loan, or personal signature loan, they're just looking at your personal stuff. For the most part, your credit and your income. It's pretty simple. If you look at a place like Lending Club, all they're really looking at is what your credit's like and what your income is. And they do a debt to income ratio calculation. And then they look at your credit, and then they determine the probability that you're going to pay them back, and they make you an offer. But when we talk about commercial credit, it's a lot more in depth, because not only are they looking at those same factors on the personal side, at least your credit in a lot of cases, but they're also looking at commercial credit. They're also looking at your bank credit scores. They're also looking at places like LexisNexis and Small Business Financial Exchange, these third-party data aggregators and credit bureaus a lot of us don't know of. And they're making all kinds of determinations, not just about us as individuals, but about the business's ability to repay. Is the loan fraudulent? Is the business set up a certain way and structured a certain way? So there's just a lot more involved with commercial loan underwriting, which makes it a lot more complex, and obviously in a lot of cases takes longer time as a result. Now, what we're starting to see is lenders have already started to kind of adjust their guidelines. They're already kind of starting to make changes to basically mitigate their risk. They don't want to lose money. And it's interesting because we saw some of the biggest players in the alternative loan space go down during COVID. On deck was the biggest publicly traded company in the alternative lending space, and they got acquired by somebody else after their stock did an absolute nosedive to nearly nothing throughout the entire process. And the reason crisis, I should say, and the reason for that is because the biggest vertical of lending right now is revenue lending. So nobody anticipated that all of a sudden all industries could see revenue disruption at the same time. And that's why that took off, because there's this idea that if businesses already have predictive revenue that's going up, that it would probably or looking into the probability that they're going to continue to go up makes sense. There's a lot of machine learning, a lot of algorithms that predict the same thing. So then all of a sudden, all revenue stopped in a lot of industries, and banks didn't account for that. So then what happens is they have to tighten up guidelines. They make changes. They do all these things to basically mitigate future risk. We're already seeing those permanent adjustments since COVID, and any other changes to the economy will help us continue to see more of them. By the way, come in. Tell me where you're coming in from. I always like to say hello and thank you, whoever it was. I don't have your name here that mentioned Noel and shared this. I always appreciate you sharing it. Brilliant Davis is in the house as well. Always appreciate you coming in and saying Hello, Brilliant Davis from Unbound Solutions LLC out of Tucson, Arizona. See how easy that is? Okay, so if you actually mention your company's name and tell me where you're from, I'll give you a shout out. It's like free publicity here. And I got somebody here from Tampa, Florida. Although I have a lot of people in here that says Facebook user, but it's not actually telling me what your name is. So thanks for coming in, everybody. I appreciate it. Financial Gospel Apocalypse, peace and love. I appreciate you coming in as well. Hello and saying hello to everybody upstate New York in the house as well. Thanks everybody for coming in. So what kind of changes are going to happen? Well, first of all, the Fed's already changed interest rates. As a matter of fact, the predictions are all over the board, but the Fed predicted that this year and next year, we could see as many as 7 interest rate hikes. 7. Now, keep in mind, we haven't really seen the interest rate hike in, I don't know, many years, I think a decade. Now, all of a sudden, we're looking at 7 in the next 2 years. As a matter of fact, they're about to do something that historically, I don't remember if they've ever done, which is raise the rate a half a point in one setting at one time. So we're not going to just see rates increase. We're seeing radical increases to what's happening with the Fed. Okay. And that also is going to reduce lending amounts. It's also going to increase income requirements. There's a lot of things happening here. But if we talk about interest rates, when the Fed raises the interest rate, then that raises the cost of people to borrow money, of lenders to be able to access money. And that raises the cost that we're all paying for that money. So first of all, we're going to see interest rates change. They're going to go up. And if we see a recession and we need access to money at the cheapest terms, now's the time to get in before we see it happen, because it's inevitable. I guess this isn't just me making it up. You could do a simple Google search of Fed rates and interest rate changes and see what happens here. So again, I think we've got multiple people in the stream and we're playing a little bit with restream. So if you see the screen come in and out and things change up, we're just trying to kind of check things out right. Again, a lot of things are going to happen. A lot of things change. A lot of things shift. And one of the things that shifts here is that we see interest rates go up. We also see reduced lending amounts. So we also see lending amounts get reduced. And I got a little issue here, so I'm just trying to see if I can. So again, guys, just making some adjustments on the fly here and still trying to figure it out when we're actually making changes on what actually is being changed. I think that comments on this street. Okay, so hide message. All right, so there we go. Okay, so we also see reduced lending amounts. So we see lower loan amounts because banks want less exposure. So they reduce the amount of money they're actually lending. We also see increased income requirements because we're worried about debt to income ratios now. That's what we're worried about. We're worried about revenues dropping. We're worried about personal income dropping. We're worried about increased in expenses. Okay, I was talking to one of my team members that said, hey, look, my monthly nut has increased by $600. Like what I got to pay in expenses that increased by $600 because of what we're already seeing with inflation. So lenders are aware of this, and that's why they start looking deeper into debt ratios, income requirements, these type of things. Okay, we also see that underperforming products we get rid of. We were really worried that revenue lending was never going to come back because all of a sudden all business revenue was disrupted at the same time. It did come back, but it took a while for it to get back. So when we see underperforming products, when we see people that have credit lines they're not using, when we see people that have credit cards they're not using, we start to see a lot of things happen. Credit lines get called due. Okay, that means, lender looks, does a check and sees that your business credit score is low or doesn't exist. They say, hey, I know I have it. You have a credit line for 100 grand. You have 10,000 outstanding. We're closing it. You've got 30 days to pay us the 10 grand that's outstanding. Very realistic. I have friends that face that all the time because of business credit issues. So we see credit lines called due. We also see a reduction in limits on credit cards and credit lines that already exist. So it's not uncommon, and we saw this during COVID, a lot of it, where lenders came in and shut down credit lines. All of a sudden, I think it wasn't Swift Capital, I forget who it was during it, but just all of a sudden abruptly shut everything down. Every credit line that they had that extended to customers was gone, and customers couldn't get more. Okay, so this happens when we see these kind of changing climates. Okay, we also see that limits on credit cards and credit lines go down because what happens is lenders want to limit their exposure. They don't want to give somebody a $100,000 credit line if they're only using 20. What they're going to do is they're going to lower that 100 grand to 30 grand. That person can still use it as they have been. And now the lender has less exposure to one person and more money available to lend to additional people. These are all very common things that we see when the economy changes, especially we saw this all during COVID. Credit lines called due. People have limits lowered on their existing cards, limit lowered on their existing credit lines. Their credit lines are just canceled. Future approvals are lower loan amounts, lower credit line limits, lower credit card limits. this all happens when banks contract because they have less money that they're willing to lend out. So they're still trying to make sure that everybody's happy. They can help as many people as they can, okay, that aren't high risk. But again, they do that by pulling the credit back from the people that aren't really using it. So again, all this just makes it harder for businesses to get funds, and it makes it harder for you to keep funds if you're not using what you have now. So what can you do? Well, you got to make sure you're fundable. Okay, I'm not going to talk a lot about this today, but it's one of the things I talk about the most and most because you got to have a fundable foundation. Like if you're going to need to get money, you got to make sure your basics are done. Okay, if you don't do this, then when it comes time to get money, then you've really got an uphill battle. You've got problems ahead. Okay. And this is what I was just talking to somebody about the other day. We were actually walking through and saying, look, you need to get yourself positioned right now for this, because when you need money, the last thing you want to be doing is trying to figure this out. And that's the same thing with business credit building. You don't want to wait until you need money to build business credit, because building business credit takes time. You want to start it now. So when all of a sudden the economy shifts, then you already have a business credit profile built. And you're like, man, I'm glad I listened to Ty. My business credit profile is built. My ability to get loans, credit lines, and credit limits is already there. Now I can go and do this. So you do it just by making sure that your business has separate information. Get an EIN number, incorporate your business or set it up as an LLC. Get your DUNS number from Dun & Bradstreet. Make sure you have a business bank account set up that you've got money running through. Have a professional business website set up, an email address. Okay, make sure that your business looks credible on paper. It's very important. And by doing so, this goes a long way to giving you a ton of credibility. Teresa from Maine Wish LLC in Reading, Pennsylvania is in the house. Thanks for coming in. Sean D from Dream 12 Properties in Columbia, South Carolina. Thanks for coming in. And Mark says Wells Fargo. Well, Wells Fargo wasn't the one I was talking about in COVID that canceled all credit lines. But Wells Fargo did cancel all credit lines, then pull back. They actually pulled back from canceling all their customers' credit lines because they had so much backlash. And they're dealing with a whole other problem because of the things they did that were unethical they got caught on. But thanks for throwing that out. Mark makes a good point. Wells Fargo was another source that all of a sudden overnight just canceled all credit lines and stopped issuing more. Okay. And then somebody says from Facebook, don't have your name, so it doesn't say, saw that happen when I worked at Capital One. And so here's somebody that actually comes from that sector and says, hey, I saw this. I was in the sector. I saw what happened. And again, I don't make this up. You can do any research. I'm not one to sit there and go, oh, drama, be fearful. I'm just saying this all is the natural progression of economic shift in our country. When the economy shifts, this is what credit issuers and lenders do. It's just the way it works. So the reason I'm telling you this now is that I'm telling you as we're nearing towards a recession to financially get yourself prepared so you're not a victim of this. So you have plenty of credit available, because anybody like we're seeing right here, anybody even in here from that works in the industry knows exactly the same thing, that this is just what happens. And Brilliant Davis says fundability really works if you follow the steps. If you follow the steps in the business credit suite, saved me a lot of headaches during the nationwide closure, especially when it was getting difficult getting supplies. I appreciate that. Thank you very much. And Brilliant Davis is correct. The reason that credit makes so much sense is because when you have revolving credit lines and credit cards, then what happens is you have it available if you need it. And if you don't need it, you don't have to use it. But you've got it if you do. When the economy shifted, just like Brilliant Davis says, that's exactly what we did at Credit Suite. We immediately moved all expenses to revolving credit. It's what happened. Instead of paying anything, everything got paid through revolving credit. Our credit lines, and all of a sudden we went from zero debt to tons of debt being accrued very quickly, which we were okay with because that kept our cash in the bank that we could pay off the debt if we needed to. But when we are uncertain, we do exactly what Brilliant Davis is doing. We start moving financing. We start moving the expenses to credit lines, to vendor credit. We start, instead of buying our office supplies on Amazon, we'll go and buy them on Staples and use our Staple credit card, or we'll use our Amazon corporate credit card. We'll start buying fuel with our fuel cards. We start moving expenses to everything away from our cash to reserve cash until we actually see what's going on. And you need to know this is what happens. The reason that we can predict recessions is because we can predict consumer sentiment. We're actually looking at consumer confidence. So one of the indicators of a recession is that consumer confidence drops, meaning that people are unsure of things. And when they're unsure, they usually pull back, right? This is what happens. We pull back, we stop spending. I don't know about you, but I'm the same way, right? COVID hit. I'm like, immediately cut all expenses. What other additional income streams do I have? I don't know what's going to happen. Let me get prepared. Anybody that went through the 2008 mortgage crisis knows these things. So again, this is the natural progression of what happens when the economy shifts. It's why you, as Brilliant Davis points out, you want to make sure that you have access to be able to get the credit when you need it, which is why fundability is so important. Make sure you build business credit. Okay. Brilliant Davis has pointed the same thing out. You want to work with starter vendors. Okay, that you actually need to manage your business. There's places like Granger that have outdoor workwear, batteries, first aid kits. There's places like Uline that have all kinds of shipping supplies, office supplies you can use to market, grow your business. There's places like Strategic Network Solutions or Phillips 76 to get fuel. There's all kinds of starter vendors you can use to buy the stuff that you really need to buy anyway for the business, but without using your cash to do it. But when you do this, you start building a business credit profile and score, and then you don't stop building. What happens is you actually use the credit that you have to grow the business. So then you move on to Staples and Walmart and Amazon and Office Depot, and you start getting credit at all these revolving stores. Now, maybe you'll use this credit sometimes, maybe you won't. You want to continue to use it so the credit issuers don't cancel those accounts. At least every 12 months, you want to use the credit, preferably every 6 months. So you want to start getting this credit and using this credit to actually grow the business. You want to leverage your credit, OPM other people's money to start growing the business. Okay. Now you're keeping more money in the bank and you can pay that credit off at any time you want to. But it helps you use other people's money to make sure that you have stability, make sure you have tons of access to cash. Okay. Then you can do whatever it is you want to do to increase revenue and profits. And you're more likely to then meet income requirements and underwriting too. It's easier to get approved for a bank loan if I come in and I'm actually showing that I'm using business credit and then I got more money in my bank. So if my bank comes in and they say that I've got, $50,000 in my bank account, and they also see that I have accounts on my business credit reports that I'm paying as agreed, that's good for me. If I use the 50,000 to buy stuff instead of using credit, now a bank looks, sees no money in my bank account, no credit history that's recent, and they don't want to lend me money. So by using credit wisely to grow, you're showing lenders and credit issuers that you have credit, that you use it responsibly, building that credit history and making it easier to get credit financing. And the other thing that you're doing too is you're keeping more money in your bank account, which helps your bank scores and also helps make it a lot easier to get approved for more money at better terms. Don't forget, personal credit does matter. There's a lot of lenders and credit issuers that look at it. There's some sources like Credit Line Hybrid where you can get money just based on it. There's other sources like SBA loan where it needs to be good to get it. So if you there's other scores like FICO, SBSS scores where personal credit's calculated into the overall score calculation for your business. So you need to make sure that you come in and that you're improving your personal credit right now. Okay. I owned a consumer credit repair company. I sold it a long time ago, but I can tell you, this is one of the problems that I often see people do is that they don't fix their credit till they need a mortgage, till they need a car, till they need something. Then they go address the credit issuers. You don't ever want to do that. You want to stay ahead of the game, especially when we know that an economic shift is imminent. It's going to happen. So when this happens, then we need to make sure that we're as prepared as possible. Building business credit was one thing. Getting to work on repairing damaged personal credit is another thing. And there's a lot of training online on how to do this. You can also work with a lot of legitimate credit repair companies out there that do it. We don't deal with consumer credit. We only deal with commercial credit, but something that you need to think about and get addressed. Plenty of sources out there that can help you. Factors that affect your personal credit, right? Payment history, debt to income ratio, age of accounts. So some things you want to focus on. If you want to get better personal credit, then get accounts that report that you pay as agreed. Okay, a lot of people think that fixing credit, consumer or commercial, is about removing bad stuff. It is. That helps. But I always tell people you can't have good credit scores without good credit. So more of having good credit is building positive and having a lot of positive out there to offset the negative. And then you can focus on the negative, but make sure you've got stuff on your credit reports that you're paying as agreed. The more of that, the more it's going to offset anything negative. Okay. Make sure you have a good debt to income ratio or utilization. Okay. So what I like to do is I like to go right now. If you haven't done this in the last 6 months, call every single credit card company that you have and say, hey, look, I'd like to see if you can raise my limits, but I don't want you to pull my credit. I'm not going to authorize like an inquiry on my credit report. And then if they say, well, we are going to inquiry, my Amex card does. My Amex says, well, we're going to put an inquiry on there. I said, well, then I don't want you to do anything. And then if somebody says, yeah, we can definitely do an assessment, there won't be an inquiry, I say, then do it. And then this results every 6 months in more and more and more limit. Okay, Discover doesn't even have a requirement. Every month with Discover, you can actually request a limit increase. And by the way, I just did this last month on a Citi card and a Discover card, and both of them raised my limits. Now, why do I care? Because the higher my limits are, the lower my debt ratio is. The more I can put on those credit cards and still keep my credit cards intact, keep my credit scores. So again, get limit increases. It's really going to help you. You can't do much about age of accounts, but if you've got a newer credit report, getting added as an authorized user to a family member's account can help. Inquiries, stop using personal credit to get business credit cards. Stop it. It's ridiculous. It doesn't even make any sense. Business credit exists for you to get all the credit cards you want at limits 100 times higher than consumer credit. 100 times higher isn't my number. It's SBA's, by the way, without an inquiry on your personal credit report, without a guarantee. Build your business credit. Use it to get credit cards at every vendor: Staples, Office Depot, Amazon, Walmart, Sam's Club, Costco, Best Buy, whatever, Apple, Dell, HP. Use business credit for all that stuff. That'll help you limit your inquiries on your consumer credit. Inquiries don't hurt you because you have them. Inquiries hurt you when you have groupings of them, meaning that the credit bureaus see you're applying for a lot of credit at the same time, usually because you're getting denied. And it hurts you even more if you have an inquiry that doesn't result in an account on your actual credit report. So if I go apply for a loan and I get denied, that hurts me more than if there's an inquiry on my credit report for a loan that I got approved for. If TransUnion sees inquiry, then loan, then it doesn't hurt my score very much. But if TransUnion sees inquiry and no loan, and then inquiry again and no loan and no inquiry, then TransUnion is saying something's wrong with this person where lenders don't want to lend the money, and it adversely affects you. So only apply for what you really feel you can get approved for. And this is what we teach at Credit Suite, right? We help our clients only ever apply for business credit accounts they know they're going to get. This takes years of business credit building, condenses it to months. But the other thing it does is it makes sure that they're not wasting time getting frustrated applying for a bunch of stuff they can't get. So limit your inquiries. Okay, make sure you have the right mix of credit. Have a couple more 1 to 2 mortgages, 1 to 2 car loans, 1 to 2 other kind of loans are okay. 3 major credit cards, but don't go shutting down stuff and losing utilization, and also or using available credit and losing credit history. If you have too many credit cards, leave it like it is. Okay, but keep in mind that having 1 or 2 mortgages, 1 or 2 other kind of loans really is going to help your credit mix. Okay, so these things go a long way to helping you improve your overall personal credit. Again, if you're just coming in, give me a shout out. Tell me where you're coming in from. I always like to say hello. So business plan. You need a strong professional business plan. Include a solid plan for how you'll use the funding, how it will help your business increase profits. If you're going to do an SBA loan, sometimes the loans you need this. But even if you don't, I recommend have a plan of what's going to happen when the economy shifts. Let me give you an example. With Credit Suite, when the recession hit, when COVID hit, we just saw hockey stick growth. Now, part of that's because we're in the right industry where people need money, but we have a vault of recession content. Every time we do something like this presentation, we modify it for a recession and we put it in a vault, a whole other folder where we have hundreds of assets. We have hundreds of social media posts, hundreds of emails. We have hundreds of PowerPoint presentations that are all recession content. And when the economy shifts, we immediately start doing more live streams and start with aggressive education about what do you do? Now the economy has shifted. Now we're in a recession. Here's how you handle that. So people start coming to us right away. And our competitors go, what is going on? How are they producing so much recession content so fast? We're not. We've been doing it for years and years. We have a vault of hundreds and hundreds and hundreds of assets that are recession based. That's our plan. Our plan is that when the economy shifts, we start going with an increased amount of education to the space. We've got all these influencers, all these people we reach out to, and we say, hey, look, your audience is probably pretty concerned. They want to know how to get money in a recession. Yeah, we need help right now. Okay, great. We've got a training prepared. Are you ready? And then all of a sudden we start going into masterminds and Facebook groups, and we get all this additional exposure, news stations. We're everywhere because we're ready for that economic shift. So a business plan, it's not even just about getting financing. It's about setting yourself up so you're actually ready for an economic shift as well. Also keep in mind that loan decisions are driven by data. Okay, that's why building fundability is important. It's why building your business credit is important as well, because that's the kind of data they're using to make those kind of decisions. So remember, set up your business to survive the underwriting process, even now and when the economy changes. Build the strong credit profile, improve your fundability. Okay, when you do just these 2 things, your business can ultimately, and a lot of times, sail through underwriting, even when underwriting requirements become more stringent. You also want to make sure your application makes it to underwriting. Don't put any discrepancies in there. You got to make sure that the information you put on the application is valid in places like the Secretary of State, the IRS, your website. They're going to validate your application to even make sure it's legit. And if the stuff you put on the application doesn't match other places like your website, your social media pages, Secretary of State, IRS, it throws up red flags for fraud. You never even make it to an underwriter. So make it to an underwriter. If people ask me and they say, if there's one piece of advice, and often I'm on news stations, okay, they'll say to me, what's one piece of advice? You talked about fundability. What's the one piece of advice you give a business owner? I'm like, make sure your information is congruent. Like, make sure that info you put on an app matches what's on Secretary of State. Just start there. And if that's right, you may be good. But I bet you, as I see 90% of business owners, the information on Secretary of State doesn't even match what's on the application. And that's your first red flag. You're going to have problems because lenders can't validate the company applying even really exists. So you got to make sure that congruency is probably the most important fundability foundational aspect you're going to deal with. You got to have that consistency. It's the number one reason that applications for credit and financing are denied isn't because you don't qualify. It's because they don't even think your app is real. They don't think your company is real because the information they're finding isn't consistent. So you got to make sure your business name, your address, your phone number is consistent everywhere. You got to make sure your social media pages, your Yelp, your Bing listing, your social media pages, your Secretary of State, your IRS, your bank account, all the stuff needs to be consistent before you even think about applying for credit and financing. That's going to help you sail through the actual underwriting process. And again, it must be verifiable. Anything you put on the application, they're going to match it. They're going to verify it. So make sure that the stuff on the application is verifiable if they check these sources. Also keep in mind, you never lie about income, okay? All kinds of people that get arrested and get in trouble for this, especially people that teach to do this, never do it. It's just going to get you in trouble. So don't try to go through and lie about income, because when they make you verify it, even if you don't verify it, you abandon the application, it still can get put into places like Small Business Financial Exchange, where it just makes you look shady to a lot of other lenders as well. And you have to keep in mind, they're going to verify everything. They can and they will. So if you're going to put something on an application, make sure it's legitimate, make sure it's credible, make sure it's verifiable. And never forget that there are places like the Small Business Financial Exchange where banks openly share information behind the scenes. So if you tell one bank one thing and one bank something else, they know it. They're communicating behind the scenes, whether you know it or not. There's just so many reasons that you've got to make sure that what you say is 100% accurate, because they will verify it. Hey, thanks for coming in from Charlotte, North Carolina, and saying hello. So remember, it's probably going to get harder to get business loans. It's going to when the economy changes. Lenders tighten up on underwriting. You got to build the fundability. You got to build your business credit. You got to work on personal credit. You got to work on setting your business up the best that you can to be able to have the greatest amount of success. So if you'd like to see where you stand now, give us a call on a free finance assessment call with us. We'll do a fundability check. We'll tell you what's wrong with fundability, what to fix, help get you on the right direction there. If you have business credit built, we'll help you get your business credit reports for free. We'll go over them with you. If you don't or do, we'll still give you tips and tactics to build your business credit quickly to get ready for the economic shift that will ultimately occur. And then you also need to make sure that you have financing. And we're going to talk to you about all the financing you can get right now, so you can start loading up on credit lines, credit cards, and loans as well. All that happens on an assessment with us. Give us a call at 877-600-2487. That's 877-600-2487, info@creditsuite.com. You can also go to creditsuite.com/console as well. And don't forget to go to the top right of our page, creditsuite.com. Take 1 minute and like and subscribe. Here's why you want to do it. On places like Insta and TikTok, we've got 1 minute training. On YouTube, we got thousands of videos. We have daily tips on Twitter and on Facebook. We've even got a podcast where you can listen on the go. All of our training is designed to do two things: help you grow and scale your business, and help you get the money you need to do so. So if you're interested in growing and scaling, you're not growing as fast, you want to grow better and faster, and you also want to get the money that you need to do that, well, then this is everything that we teach about. So all you have to do is take 1 minute, subscribe on our channels, and keep your eye out for our next training where we go through all these ideas and concepts with you. So I'm going to go ahead and wrap up. Thanks for tuning in. I appreciate always your time. We're going to be back next week to talk more about cool ways to get money to start and grow your business. Until then,